Okay. Welcome to the quarterly Zoom webcast, although we rename it the quarterly Teams webcast today. And the topic is navigating market uncertainty. We figured this is a pretty good metaphor for navigating uncertainty because we had a lot of uncertainty as far as how we were going to accomplish this call. A quick comment about the title, Navigating Market Uncertainty, Not for the Faint-Hearted. This is a little bit of a combination of the commentary that Peter did at the end of March, which was called Not for the Faint-Hearted, and the quarterly letter. There's somebody that's not muted here that I keep getting interference for. I was writing letters out called Navigating Market Uncertainty, so we actually combined the two titles. I think it speaks appropriately to the times that we're in, navigating market uncertainty, not for the faint-hearted. And I would like to welcome all of you. I'm Richard May. I'm the Managing Director at the RKM Office of Baldwin Management, LLC. And I'm joined today not only by Christina, who's emceeing, but also by Peter Havens, who is Chairman of Baldwin Management, LLC, and one of my bosses. And Peter, do you want to say something before we start into the meat of the argument here?
Well, I just want to welcome you all and thank you all very much for your valuable time. We hope to make this as informative as possible. Please ask as many questions as you would like. And Richard, I'll turn it back to you.
Okay, thank you. And usually we start at this point with Christina reading the rules of the road, but she's already done that, so we don't need to do that. I just wanted to make a comment appropriately, the rules of the road, because we are on a bumpy road to an uncertain destination. And we hope to shed a little bit of light on how we're reacting to what's going on in the universe, and maybe give you some thoughts on how to cope with it and best approach it. First, I want to differentiate between risk and uncertainty. And this seems a little academic, but bear with me for a minute. There was an economist in the 1920s named Frank Knight, and he entered an essay contest in Massachusetts and wrote an essay about risk and uncertainty. It turns out he finished second in the essay competition to a guy named E.E. Wheeler, who wrote a piece on municipal lighting. The municipal lighting piece was published right away, but Frank Knight's piece on uncertainty went unpublished for about 4 more years, but it pretty much then became one of the foundations of then modern economic thought, which includes Keynesianism and a lot of this teaching of the subject of economics that went on for the next 50 years. So he was a very influential economist that distinguished between risk and uncertainty. And if I could do a real nutshell differentiation, if you had a cup with 3 dice in it, and you had to determine what the odds are of the number 12 coming up if you rolled the dice, you'd be able to compute that because you knew there, X possible results, and the results that add up to 12 would be 3 4s or a 6, a 5, and a 1, or there are a number of commutations and permutations. You could measure it and bet accordingly with something like that. So that's kind of the classic definition of risk. If I told you that that same cup had 3 things in it, but I wasn't specific about what they were, whether they were dice or marbles or something with very large numbers in it, and if you had to predict the chances of the number 12 coming up in those circumstances, there'd be no way you could do it because you don't know enough to be able to compute the risk and therefore the odds of something like that's happening. And his premise was that at certain periods in economics, the uncertainty reaches that level, which is now called Knightian uncertainty. And I contend that we're in one of those eras that you see the word uncertain in almost every headline these days. And uncertainty is not risk. Uncertainty is a whole new beast among themselves. You can measure and manage for risk. You have to navigate your way through uncertainty. Having said that, Peter and I come to this table with some education, but more importantly, many years in the trenches. And both of us went to what are now described as elite universities. We both got MBAs from leading business schools, but it wasn't until we started working in the trenches that we really started understanding what really goes on in the investment markets. And between the two of us, we have, I think, Peter, please correct me if I'm wrong, probably 8 decades of experience.
Speak for yourself.
I know the first thing I remember is the recessions of 1971 and 1974. And I had just gotten out of the university where I studied under Burton Malkiel, who wrote Unsafe at Any Speed, Random Walk Down Wall Street. And what just out of curiosity, what's your earliest memory of an economic or a market event?
Mine would be in the 70s when I started in the business. As I was saying to one of our colleagues earlier, that was a period of time when the markets really didn't do very much, and it was not a pleasant time to be an investor. We were dealing with things like stagflation, and as a consequence, not a lot of progress was made. And so coming to work every day was not a real pleasure.
The one thing that we do remember from the 70s was real estate was hot. And some people were asking, why should I invest in the stock market when I can make money in real estate? I don't think we're back there yet, but we certainly have a different universe that we're dealing with. Just to make sure everybody knows, we're not here today to talk about any threats to democracy or the rule of law. Our beat is the economy and the investment markets. And we'll share with you what our individual perspectives are, as well as how we are suggesting to our clients how to cope with this environment. And I would ask Peter, if you don't mind setting the stage. You wrote your commentary right toward the very end of March, and it was pre-Liberation Day. And I think a lot of the slides and your commentary address where we were on April 1st, on April Fool's Day, before we went to the April 2nd, which was Liberation Day. Could you take it away?
Sure, be happy to. So Christina, if you could bring up slide number 1. So as Richard has described so eloquently, we are in a rather tumultuous time. And there is a great deal of uncertainty. Here on slide 1, we see a representation of consumer expectations. This is a monthly slide that comes out from the University of Michigan, and it's done via a survey. And so here you see how consumer expectations, this slide was as of February of 25. Since then, you can see how it's rolled over, and you can see it was at a level of 64. Well, since then, I've just gotten some new information. It is now down to 50.8. So it has continued to roll over and decline. You go to slide 2, please, Christina. What we're going to see is essentially from a different source, essentially the same message. Consumer expectations have rolled over. The U.S. consumer has gotten to be much more pessimistic. Now, why is this important? Because the consumer in the United States represents about 70% of the economy. So you don't want to get the U.S. consumer upset, because when the U.S. consumer gets upset or bewildered, they have a tendency to pull back. They have a tendency to no longer consume. So if you go to slide 3, please, Christina. And this is evidenced by some hard U.S. data. The first 2 slides come out of surveys. one done by the Conference Board, one done by the University of Michigan. But now we're looking at U.S. real consumer spending month over month. And you can see if you go to the far right that in the first quarter, you could see that the consumer really started to pull back. So if you have 70% of the U.S. economy starting to pull back, then you have to start wondering what's going to happen with the U.S. economy. So if we go to the next slide, and here we're going to look at a different market. So this is no longer the U.S. consumer, what the consumer is doing. We're now looking at the U.S. dollar. We've written many times in the past about the dollar and its role in the world as a reserve currency, and the flexibility which being in that position has offered the United States. Where here you can see that the dollar, now this is the dollar versus a basket of major currencies like the euro, like the yen, like the renminbi out of China. And you can see that the dollar peaked out at about 110 late in 2024 and has declined. It is now just below 100. So it's had about a 10% reduction. Now, why is this important? This is an asset, i.e. the US dollar, that's not just held by Americans, but it's held by millions of people around the world. With the US dollar being the world's reserve currency, it is the instrument that people use to conduct trade, to make exchanges, to buy and sell. And we as a country have always espoused a philosophy of we want a strong dollar. And as you can see, for considerable periods of time, we have had a strong dollar, but right now we're running into some weakness. What we don't want to see is the dollar get to be too weak. That will promote inflation on the one hand, and also it will unnerve foreign holders of dollars. They might start to think that the dollar is no longer a safe asset and decide to exchange that dollar for another currency. Could be the yen, could be the euro, who knows? Now, not all doom and gloom here. The dollar has fallen off. The dollar has fallen off in the past, and we're not down where we have been in the past, and we have survived as a nation and as a reserve currency. As you can see, in 2018 and 2021, the dollar traded at 90. So we're not at 90, we're not at 110, but we have weakened a bit here, and we're now trading at 100. Christina, please go to slide 5. Now, in these two slides, we're taking a look at another couple of aspects of the U.S. economy. On the left-hand side, employment. So far, now again, these numbers were captured primarily before Liberation Day, but we've recently had an employment number that was stronger than what the markets expected. And as you can see in this left chart, jobless claims are running at lows, historical lows. And all this is depicting is that employment in the United States is historically high. And that's a good thing. When people have got jobs, when they're earning money, they typically tend to spend it. So while sentiment has rolled over and people are questioning, people are wondering, people are getting a little bit gloomy, and we've seen some indications that they might be thinking about pulling back on some of their spending and have pulled back on some of their spending, they're still employed. And as long as employment stays high, we would argue that the consumer is going to continue to spend. So We got to be aware of what the sentiment is, but we've got to be more aware of exactly what they're doing. Now, on the right-hand side, we're taking a look at the bond market. Lots of people, we included, like to focus a lot on the stock market, but the stock market is nowhere near as large as the bond market is. Bond market's many times larger than the stock market. And it is really the investment dog, if you will. And so we've got to be very aware of what's going on in this marketplace, because it is competition, if you will, for investor dollars. They can put it in the stock market, they can put it in the bond market, and they do readily interchange between these two markets. So here you can see, and as we wrote in our quarterly commentary, this chart has been updated, but you see the dot, the lower dot on the far right-hand side of the chart. That's what was depicted in the quarterly commentary, because at that time, U.S. corporate spreads were quite tight. They were only a little over 1%. And as we wrote in the quarterly commentary, that meant that the bond market was really, at that point, was really quite calm about the condition of the U.S. economy. It wasn't fearful that we were going to go into a recession or something untoward was about to happen, because to do that, if the bond market believed that, the spread would widen between junk bonds and treasuries. And that's what this corporate spread is depicting. It is depicting the spread between high yield junk bonds and U.S. treasuries. So a few weeks ago, at the lower dot, the spread between high yield bonds and U.S. treasuries, i.e. junk bonds and high quality bonds, was only a little over 1%. So the bond market was very relaxed about the economy. Well, new news. I captured this as of yesterday. The spread has ballooned up to 4.14%. So the bond market has had a setback. The bond investor is now demanding more yield for investing in junk bonds. That means there is some concern amongst bond market investors in the bond market that they're not too sure that this economy is running as smoothly as it should be running. Now, let's put this into some historical perspective. The bottom of the page, you see long-term average for this spread between junk bonds, i.e. low-quality bonds, and treasuries has historically been 5.27%. So we're not as low as we were. The bond market is not as unconcerned as it was recently. Their concern has now crept into the market. The spread has widened to 4.14%, but we're still not to the long-term average, which is 5.27%. But we must be aware of this movement in pricing. Chrissy, if you would go to the next slide. Now, lots of analysts have come out with their predictions for Q1 GDP growth. And one of the better ones out there is the Atlanta Fed. And they have a tracker, a GDP tracker, they call it. And that gets updated, I believe, almost every week. And they look at, it's a gathering of about 30 different statistics that they put into a formula. And so as those statistics get updated during a month, they input those statistics into their formula and they come out with a new estimate. Well, as you can see in March, they estimated that the first quarter GDP was going to be a negative. It's going to be a negative 2.83%. Now, that has been since updated, and it is still negative, but not as negative. So what caused this? what all of a sudden happened to make this estimate, because as we had gone through the fourth quarter of 2024, various analysts we had strong growth in the last quarter of last year. Most analysts were looking forward to another strong period in the first quarter of 2025. And then all of a sudden, estimates fell out a bit. So Chrissy, if you could go to the next slide. This is probably the main reason first quarter GDP estimates fell out of bed. This is a graph that takes a look at U.S. goods exports and imports. The imports are the solid blue line atop, and the export line is the dotted line below. And the gap between the two looks at our trade deficit. And as you can see, our trade deficit, if you go all the way to the right side of the chart, our trade deficit widened quite a bit in the first quarter of 2025. And why is that? Well, because we think, and quite a few other analysts think, when word started spreading that tariffs were going to be imposed, everybody rushed their orders in. Everybody tried to capture goods from overseas to import as much as they could before the tariffs hit. So you can see the imports ballooning, but the exports, i.e. what we were selling abroad, hardly moved, stayed relatively flat. And so we believe that the first quarter negative GDP growth is really quite anomalous. And that's because of outside forces that would not normally be there. People rushing to sort of get in before the tariff curtain fell and get their goods to the United States, and not only get the goods that they wanted to get, but get even more goods. There have been lots of stories where people went to the bank and borrowed a whole bunch of money to double their orders so that they could bring it all on shore and avoid the tariffs. So we are not sure at all that we're going to have negative growth in the first quarter of this year. It's going to be very close. It's going to be right around zero. It could be slightly positive, or it could be slightly negative. The latest estimate from the Atlanta Fed is that it's going to be slightly negative. Why does one concern themselves? Well, the formal definition of a recession are 2 consecutive quarters of negative growth. So if we were to get a quarter of slightly negative growth, and if the second quarter were again slightly negative growth, then you would qualify, if you will, for the official definition of a recession. And nobody wants to be in a recession. And then finally, if we could, Christina, go to the next slide. So we've looked at the consumer, and we've seen charts which demonstrate quite vividly that indeed the consumer sentiment has gone pretty negative, and it's fallen very sharply. And this is all because of policies and confusing policies that are coming out of Washington, D.C. Tariffs are on, tariffs are off, tariffs are on again. We're only going to pull back some of them, then we're going to reimpose others. Only these goods are going to get tariffs, and only this country. We have all heard it. It's been very confusing. Well, this has also affected investors, and we can see this now. This is over an extended period of time. And you can see in the red line, this is the investor sentiment survey bearish versus the investor sentiment survey bullish. So the bearish line is the red line, and the bullish line is the blue line, or the green line, I guess, blue-green. And so you can see how the red line has spiked to the far right, and you can see how the bullish sentiment has plummeted. So this is just another indicator that sentiment is not good in this country. So we've got the consumer that's feeling confused and wondering what's going to happen. We've got investors who are feeling confused and wondering what's going to happen. And so that's being reflected in the volatility, certainly that we've got in the marketplace these days. And we may be seeing some of that with regard to sales figures as we go forward. And with that, I'm going to turn it back to Richard.
Thank you, Peter. These charts tell a really good story of what's going on. And, I guess we really don't have to pinpoint exactly what happened between March and today. But on April 2nd, President Trump announced tariffs that I think were somewhat surprising, not only to investors, but also to consumers and even the media. I saw an interview. I'm going to make two references to Mark Zandi. Mark Zandi is a leading economist with Moody's. The reason I'm partial to his particular thoughts on economics is he used to occupy this building and would give press briefings directly from his studio on the second floor. He's subsequently moved his operation out of here, but he's still spot on as far as a lot of his economic prognostications. The day before the tariffs came out, I saw an interview with Mark, and he said as long as the tariffs were reasonable in size and consistent in applications, they shouldn't have much of an effect on the markets. Well, of course, what we saw the next day was not only were they not small, some of them were 50, 60, 75%, but they were all over the place. And there were some 10% tariffs, there were some 39% tariffs, some 50% tariffs. And the formula they used to compute the tariffs, which has been analyzed at some depth, was really taking into account only one simple set of parameters. And the trade deficits are really a lot more complex than just the rate of tariffs. So I think the market fell out of bed as soon as the tariffs took place. There were 2 or 3 days where the market was down precipitously. And then there was some pronouncements coming out of the administration and the Treasury Department that this was just a period of adjustment and this really wasn't, they weren't particularly worried about it. I think Mr. Trump went out and played golf for 2 days to try to give the impression that he wasn't worried about it. But the bond market and the bond investors were worried about it. And it was the bond market and people like Jamie Dimon and Secretary of Treasury Bessent that finally, I think, convinced the president to at least put a hold on the effective enforcement of these tariffs. He left some tariffs in place. Increased the tariff on China. There was some relief in the market. There are not very many times in the past where I remember the Dow going up close to 3,000 points. The Dow used to be 3,000. So going up 3,000 points is pretty dramatic. And what we've seen, even going up to today, is a period of more relative calm. Today isn't particularly calm. I just glanced at the market and the Dow's down 700 points. Today, the Nasdaq's down 500 points. So we may be back to a little bit of whipsawing. But the tariffs in their present form are what's really causing some or most of the problem. And it's not necessarily just the fact that there are tariffs, that they're so variable and sort of actually a little bit hard to wrap your mind around, creating this uncertain zone. As I said earlier in the call, we're on a bumpy road to an uncertain destination. I looked back in history to see if I could find any equivalent periods, and there was a period of tariffs in the first Trump administration. That was a little bit inconclusive because they were very selective. But back in the early 70s, President Nixon put what at the time were called import duties on. And it was a 10% pretty much flat import duty on goods coming in from overseas. Uh, Simultaneously with that, he introduced wage and price controls. So it might have been a little bit of a double whammy, but this caused a absolute paralysis of business activity and a drop in business and consumer confidence. And it ultimately led to stagflation that persisted through most of the 70s. And some people even say that the introduction of the euro was a response to some of Nixon's activities in the early 70s. I don't know. Obviously, there are interpretations of history that might be different, but obviously, that tariff experience was not a good one. So those were in place for 4 months, and 4 months did do significant damage. The 70s were not a pleasant decade for stocks. So I think what we should do now, because we're just about halfway through the call, is talk about specifically what this means for our individual investments in bonds, what it means to our individual investments in dollar-based assets, what it means to our investments in commodities, including energy, but most importantly, what it means to our investment in equities, both in the case of Baldwin Investment Management individual stocks and in RKM, a Baldwin company, mutual funds and ETFs. So if we could take turns on this, Peter, first, can you lead us on the bond market since you talked about that a little bit already? Clearly, there was some weakness in bonds. At the same time, there was the weakness in dollars. And what does it mean to individual holders of either corporate, treasury, or municipal bonds?
Well, I think it means that unless you're extremely brave, probably one should stay with rather short duration and high quality. So at least investment grade and better with regard to quality of the bonds, and don't go too terribly far out as far as maturity levels. I think right now, in these very unsettled times, to make a bet on a 30-year bond would be somewhat heroic. Some would consider it heroic, some might consider it insanity, because we don't know if something untoward is not going to break out. We don't think at this juncture that inflation is going to break out at all. We think inflation is still pretty well tethered, but it could be the case that there is an accident. So we have to be aware of that. So short duration, high quality bonds. It's a very liquid area of the market. So to stay with that. As far as the dollar goes, again, we don't want to be too pessimistic about it. The dollar has lost some altitude early this year. We've been lower with the dollar against a basket of currencies in the past. We may get back down there another time, who knows? But there's nothing still which presents itself as a real alternative to the dollar as the world's reserve currency. The dollar is used by too many people and too many places to believe that in the short term that it's going to be dumped on a wholesale basis. I think what this episode does that we're going through right now, because we're hearing it more and more conversation, the question is being asked, is the U.S. a reliable partner? Can we trust the U.S. to fulfill its obligations, whether they were explicit or implicit? Jamie Dimon came out the other day thinking that, well, if the tariffs are in place for just a short while, and what he means by a short while is, several months. Well, okay, fine. a little scuffle between some friends and we need to get a couple things straightened out, and no harm, no foul. It will go away, and people will go back to their corners. But he said the longer this goes on, they always start breaking the bonds of trust. And that's going to be more serious because we cannot live in a world without our allies. We cannot operate in a world without our friends. We cannot be an island unto ourselves. So as long as we can regain people's trust, then we're going to be okay. But if those bonds of trust get broken or severely damaged, then you're going to hear more and more conversation about, well, I don't want to have all of my assets or even possibly a majority of my assets in the US dollar. I'm going to start diversifying. I'm going to start increasing my weightings in the euro and the yen. Those are the two other major currencies that are used around the world. I'm going to start putting more money into Europe or Japan in their bond markets, in their stock markets, and we don't want to have that happen, certainly precipitously, and we don't want to have that happen in a large way.
So I'll take the mutual fund side of it. As you probably know, and as most of our clients that are on this call, we've used bond funds historically in the past for probably the last 30 years as a decent way to participate in the bond market. Every once in a while, somebody would come with an individual bond. We didn't sell it to put it into a mutual fund, but we didn't feel the need to hold a Bristol Myers bond as opposed to a Vanguard intermediate bond fund or something like that. The difference is not that the bonds are less safe assets, but we're on the cusp of probably a extended period of interest rates gradually moving up. And bond funds is a little bit more problematic when interest rates are heading up than heading down, as they were for the last 30 years. So we've picked more individual bonds, especially US Treasuries, within the last year in order to get the certain return that we know if held to maturity, a 6-month or a 1-year or a 2-year bond will give us. I know that there's been more trading in bonds recently. Goldman Sachs and I think Morgan Stanley just announced earnings for the first quarter, and they made tremendous trading profits, not only in individual securities, but in bonds as well. More in stocks than bonds, but people are trading bonds now, and I don't know. I'm not sure that that's a good development. Once people recognize that they can make money as either stocks or bonds go down in value as well as going up in value, I'm not sure that's a good development. So I think what we're dealing with is a lot more volatility, and we're probably seeing, in a way, a more trading environment in bonds and stocks than has existed in the past. I don't know if we've seen these numbers yet in option executions, option sales, but I would imagine we will. And that the crowd that were buying meme stocks and DJT stocks and the popular destination for money in the pandemic are probably going to eventually discover new ways of participating in the market that just enhance the returns but increase the volatility. So I think we've, to again use the metaphor, a bumpy road. I think there is a bumpy road ahead. One other citation of Mark Zandi, if I may. I watched a piece that Mark did on, I think it was CNBC yesterday, and he was asked what damage so far had been caused by the tariff. And he said, effectively, it's not necessarily the damage that's been inflicted so far, it's that nobody knows what to do and that everybody's sitting on their hands. And the damage will probably show up later and postpone plans to expand this division or that division. It's hard to believe, we were talking about this earlier today, it's hard to believe that any manufacturer in this environment would move a assembly plant or a manufacturing plant from Mexico to Nevada just on the basis of the rules that exist today, because the rules can be changed in an instant with a signature. So I think, and you mentioned this earlier, Peter, we need certainty before we can sort of calm this whole thing down and return to a more normalized environment. As far as the dollar is concerned, you can, with ETFs, actually make an individual bet in a certain currency. You can buy an ETF that holds euros, an ETF that holds yen. You can have an ETF that holds Swiss francs, Hong Kong currency, and the renminbi. You can actually make a ETF bet on the dollar going up or the dollar going down. So I don't think this territory is particularly discovered yet by the high frequency traders, but I imagine if currency movements continue the way they are, that environment will be discovered. So we're probably talking about more volatility in the bond market, the stock market, and eventually in the currency market. Speaking of ETFs, there are also ETFs that will let you profit from increases in prices of commodities, not even to mention energy. But there's one particular ETF that's a master limited partnership that we've held pretty widely. And that's done quite well over the last period of time, certainly this year to date, although the commodities are all over the place this year. I know that Baldwin doesn't invest in commodities, but what is your base opinion on commodities, including energy, which obviously you do place close to your heart there?
Well, the oil markets are rather unsettled right now. Oil entered the year trading at around $80 a barrel. It is now down around $60 a barrel. And that is primarily because of concern about world economic growth or lack thereof. First, it was about China, because China's economy, while they report strong numbers, if you dig beneath, you see that the Chinese economy is really rather weak. And you see it in their import and export of commodities. First, it was worry about the Chinese economy and slow growth, and so lack of demand for oil. But now that has spread to the rest of the world. And the IEA, the International Energy Agency, has brought back their demand outlook for oil in 2025 to, it started the year at about 900,000 barrels to 1 million barrels a day growth, to now it's down around 500,000 barrels a day of growth in demand. We've also seen the natural gas markets coming out of the winter season. They're now getting a little bit soft. That's not unexpected, because we've got a transition during the spring into the summertime and get into air conditioning. We would expect natural gas prices to pick up as demand for air conditioning goes up, because a lot of power plants are powered by natural gas. Copper has fallen off. Copper is, I think its nickname is Dr. Economy or something of that nature. Copper is used throughout the world's economy in so many different products, from transmission lines to parts in automobiles, to electronic products, et cetera, et cetera. And again, because of economic concerns, the price of copper has fallen off so far this year. Started the year around $5 a pound and is now trading down around 4 and some change a pound. Those are the main. Iron ore has also fallen off. again, reflective of concerns about the economy. If, iron ore's primary use is the manufacture of steel, and if you've got concerns about real estate development, you've got concerns about industrial production, people are not going to be using as much steel. So as a consequence, the demand for iron ore falls off. So we see a number of different snippets of information which would suggest that other markets think that the economy is going to be on the softer side. And then you add on all the concern or question about tariffs. And as Richard just said, people just make the decision not to decide. They just sort of say, okay, I'm just going to sit here because I don't know what's going to happen next.
And I know what's going to happen next. We're going to talk about stocks.
Okay.
So let's save the best for last. Everybody, I think, aside from real estate that they may own, probably has a greater percentage of their assets in equities, either through individual securities or ETFs or mutual funds. As many of you know, the RKM operation for years used almost exclusively mutual funds. When ETFs were introduced into the system, we started using ETFs, and they've become much more popular. They're much more tax efficient, and they've become truly mainstream. So we're probably have more in ETFs at this point than we do in mutual funds. But as far as approaching uncertain times, owning an individual mutual fund, especially if it's the best in breed, which is what we generally like to own, there's a manager in there that's making decisions on what individual stocks to own. Unless it's an index fund that's owning broadly the 500 top stocks, we have a manager in there that's selecting those individual companies that will take advantage of the disruption rather than being disrupted by it. And the safety that's implicit in that is that if they're really, really worried, they can go to cash. In some funds, they can even short the market if they think the market's heading south. One of the mutual funds that we use is Luthold Core, which is based in Minneapolis. I visited the mutual fund company last summer and have great faith in their model. They're right now under 50% invested. They have the other 50% either in bonds or short-term cash investments, or even some betted against the market itself. So an individual mutual fund can take precautions itself to preserve your capital, even if it's a U.S. equity fund. And as many of you know, also, we're a firm proponent of having a significant part of your portfolio in global investments. And what we've been doing recently is moving a little bit more away from the balanced global, in other words, the global funds that are about half US and half international, toward those that are a little bit more heavily weighted toward international stocks. Because global means global, and it includes the US. So we're not making major changes. We're sticking to our what we call our four square model, which is 25% in income producing assets in cash, 25% in straight US equities, 25% in global, allowing the global manager to make the selection of US versus global. And lastly, the biggest category that we've added is alternative and hybrid. We've always had a 5 to 10, even a 15% allocation to that. We're up to 25% allocation to that, although I think Baldwin considers some of our components of the alternative to be sectors like energy, real estate, infrastructure. Those are sectors, or those are subclasses that don't necessarily move the same direction as the general US market. So by the diversification and the lack of correlation, it gives some protection against a substantial decline in the market. So that's what we're doing. And I think Baldwin's doing a variation of that theme.
So Chrissy, would you go to slide number 9? We are investors in individual stocks and bonds, if you will. And this chart looks at a long period of history. And as we're sitting here today in this uncomfortable market, which we're experiencing, we try to encourage clients to think about the long term, if you will, and not focus on the short term. And what this chart amply demonstrates is that even during years where there are significant drawdowns in the market, i.e. the market at some point in the year has gone down rather sharply, over the last 45 years, in 34 of those 45 years, the market has ended up in positive territory. That is 76% of the time, the market has gone up despite having a significant drawdown during the year. That drawdown unnerving investors and say, oh my Lord, are we going to go to zero? No, in fact, the market turns around and goes up. So that the house bet, if you will, and this has been true for even longer than 45 years, is that the market goes up 70% of the time. So to bet against the house is a very risky bet. And the important thing here is it's better to stay in the market. If you're an investor, if you're a long-term investor, it is much better for you to stay in the market than try to time the market. And if we go to the next chart, please, Chrissy. Here's another chart put out by JP Morgan. This looks at various asset weightings from 100% stocks to 100% bonds and over different time periods. So you can see that stocks in the 1-year time period can be quite volatile from a negative, this is the far left-hand bars, from a negative 37% to a positive 52% performance. And then you get bonds can be in a 1 year down 13 or up 33. And then a 60-40 portfolio, 60% stocks, 40% bonds, can be down 20% or up 34%. But then as you look out over time and extend your time frame for investment, if you go out to the 20-year, and that's the far right, you can see that 100% stock portfolio has always outperformed other asset classes. And the volatility is up 6 to up 18. So it's never been negative. It's always been positive. Whereas bonds can be -1 to a positive 11, and a 60-40 portfolio can be a positive 5 to a positive 15. So again, what we advise clients is be long-term in your outlook. Yes, there are always periods of discomfort, but we've always gotten through them, and we'll get through them again this time. And before I go on any further, Chrissy, I've noted that it says we've got 5 minutes left.
I got the same notice, Peter. I don't know what it means. So we've been on this call for an hour. We started it before an hour and 21 minutes. Why there'd be but if we suddenly go blank, that would be.
Chrissy, you're muted.
It won't turn off. It's just a notification that we've gone an hour.
Oh, okay. All right, fine. So let's open it up for questions. We wanted to do that.
I'll just remind everybody, at the top, you can hit that little hand icon, and that will raise your hand and put you in the queue to ask questions. Or if you want, you can put a question in the chat, and I will read that out loud. There was a question in regards to tariffs earlier. It says, is the situation truly unique now in that tariffs are not being manipulated for economic reasons, but simply to use as a bargaining chip for other sorts of deals?
I would answer that saying that's what we had all hoped for. And the tricky part is that we've seen multiple explanations for what the tariff's supposed to do. At one point, it was the Canadian and the Mexican tariffs were put on to prevent the infusion of drugs into the thank you into the country. And I'm not sure that was a completely legitimate objective, but it certainly would. We've certainly gotten some leverage out of having 30 or 40% tariffs on a place like Vietnam and even China. The question is, I know there was some questions yesterday. I don't know if it's the Danish that were asking, what is it that you guys want? Didn't we hear that, Peter?
Yes, yes. There's a lot of confusion out there as to exactly what the purpose of these tariffs are. So, and that's why we have the volatility in the markets that we have. That's why we have consumer sentiment as low as it is. That's why we have investor sentiment, which has deteriorated. So there's just an awful lot of questions.
I'm going to raise this point, Peter, and did your comment on it. This is a quote from Jim Grant of the Interest Rate Observer. Treasuries and the dollar get their strength from the world's perception of the competence of American fiscal and monetary management and the solidity of American political and financial institutions. Perhaps the world is reconsidering?
Well, as I mentioned earlier, the question is arising more often. It used to be the case that we all wanted a strong dollar, and the United States was held up as a paragon. The question is being raised more and more. So it's yet to be determined because we're new into this, so we shouldn't get too doomy gloomy about it all. This is stressful because it is so different from economic policy that has been practiced in this capitalist society ever. I know certain people like to refer back to President McKinley, but that was a very different economy. We were not the service-oriented logistics, supply chain, internationally spread economy that we are today. We were essentially a continent unto ourselves, which did very little trade with the outside world, and we were not a world power. World powers were in Europe. We were just sort of this, well, beyond colony, but this new world adventure, and nobody really paid much attention to us. So to compare the two periods, I think is a fool's errand, because we're just not the same. Where we are today is very different. So what's being practiced today is very different. It is unique in the history of our country. And because it is unique and it's new, people are not used to it, and thus they're confused. And we're going to have had that experience and get through it to the other side and say, oh, okay, now I understand how this works.
The next question we have is, should we assume there will be significant inflation over the next 6 to 12 months as tariff costs, hundreds of billions, are passed on to consumers? If so, would the Fed attempt to slow economic activity in response? And wouldn't that be in opposition to the imperative for companies to borrow cash to reshore factories?
That's a great question. I would say that the Fed is hoping it's a one-off, that the prices make a quantum jump up because of the tariffs, and then inflation will level off. but they may have to raise interest rates in order to make that happen. Because once that inflation mentality gets into people's minds, it's almost a self-fulfilling prophecy. So there's going to be a battle with the Trump administration wants interest rates to go down. They want the dollar to go down. And all the natural forces here are forcing those things almost in the opposite direction.
I would also add, if you go to the commentary, there was a section of the commentary that raised the question about is a 25% tariff really a 25% increase? Or is a 10% tariff really a 10% increase? And it really depends upon the product that is being tariffed. Just quickly, if it is a product which is highly desired and hard to get, and the tariff goes up by 25%, then the price is going to go up by 25%. But if it is a product which is not highly desired and is ubiquitous, there are several sources for it, and you put a 25% tariff on it, it isn't going to go up 25%. If it goes up at all, it would be surprising. So it's a good bit more nuanced. The headlines would scare anybody. They sort of sit there and say, oh my Lord, we're going to have a 100% increase in tariffs. You don't know that. And that's another part of the confusion that analysts are having and which now seeps down into the markets, because we don't really know until we will know, and that won't happen until the tariffs are put in place and they're operating for a while. We're not really going to know what the price increase is going to be. And then, as Richard said, how long is the tariff going to be in place? If it's around for just a short while, well, then it's probably not going to have any effect at all. If it's around for a long while, if it's not just a bargaining tool, if it's not just a way to strong arm a trading partner into changing their behavior, well, then it's going to have more influence on the economy. So again, it's another piece of why analysts and company managers are saying, I just don't know how this year is going to unfold. In fact, we're starting to see some company managements either present under scenario planning 2 different earnings outlooks for the year, because if it's under one scenario, under one economic scenario, this is how we're going to do. But if that's not the economic scenario and this is the economic scenario, then that's how we're going to do. So they're providing that sort of guidance, which could be, a wide spread between earnings estimates, or they're withholding guidance. They're just pulling it. Late last year, they might have said, well, 2025 looks like we're going to earn $5 a share. They come out and they report their first quarter earnings, and so far, earnings, and it's early. I underscore that. It's early in the earnings season. But so far, earnings have been quite strong. But we could run in, and we already have run into, a couple of companies saying, we're pulling our earnings estimates for the rest of the year because we just don't know. And we're not going to know for another several months. So we're pulling our earnings estimates. That means analysts are going to have to work even harder this year because they're not getting any guidance.
The next question is, what is the risk that less favorable to the U.S. trade partnerships will develop in the chaos? My understanding is that the grain markets have not recovered from the 2018 flexing of tariff muscle.
Yeah, let me briefly comment on that. The farmers, I think, are still worried. They're obviously one of their biggest customers is China, and the Chinese are very savvy about realizing they have some clout if they go to the farm community and place tariffs or embargoes on U.S. farm products. I don't think they're winners in any tariff trade war, any tariffs or trade wars. And the longer it goes on, the more both the US economy and the Chinese economy especially are going to suffer. And unfortunately, um, that's a reality that I think the adults in the room in the Trump administration, or the leaders anyway, the economic types, are very aware of, and hopefully will guide us through the maze of trade negotiations.
I would only echo what Richard just said, especially about farmers. Farmers lost market share in China last time. They're going to lose market share again. They lost it to Brazil last time. Brazil was not much of a factor in Chinese imports of ag products. They became larger than the United States was the leading trade partner to China as far as ag products. We lost that position to Brazil. So they are now number one. And we're going to lose more market share because, again, not only the Chinese going to shift because of this issue, if you will, but it's that sense of trust. Are we a reliable partner? And once that gets damaged, then it's hard to get it back. And last time, the farmers were supported because tariffs that were paid by one sector of our society got paid over to the farmers to support them. And we're going to do that again. So that's just the way it works.
One last thought on that, Peter, is there was a brilliant article by Adam Posner of Peterson Institute, where he sort of comparing and contrasting the Chinese cards that they hold versus the American cards that they hold, and to use the Zelensky model, if you don't have the cards. He concluded that the Chinese have a better hand to play than the Americans do. So we would be wise to keep that in mind.
The next question. In this time of uncertainty, what, if any, leading indicators should we watch? We discussed several indicators today that I suggest are lagging, example, unemployment, trade deficit, etc.
Do you
The
have some
10-year bond.
10-year?
The 10-year bond. Watch the yield on the 10-year bond. If that gets close to 5, then we may have some real trouble.
I can add to that I'm watching, making sure that the Treasury Secretary doesn't resign. That would not be a good sign.
All right. And then the last question we have at the moment is, how much Treasury debt does China hold, and what are the ramifications if they start to quickly divest of this debt?
Peter, you and I were talking about that this morning.
Yep. They have $750 billion of U.S. Treasury debt. It is a weak point for us. Now, there are quite a few people who are far brighter than I am, who have suggested that the Chinese would never pull that lever to precipitously sell U.S. treasuries, dump them on the market. And they argue that it is because the Chinese economy is too intertwined with the U.S. economy. And I think that that's true. The only thing I worry about is emotional moments. Now, I think cooler heads will, I think everything so far is being controlled by somewhat cooler heads. We've seen this importantly, and I think we've got to keep this in mind. The administration does watch the markets closely. The Treasury Secretary is very connected to some very savvy market people, and they are in his ear. And we've seen examples when the administration has proposed tariff policies, which the market considers way too extreme. And you see the market sell off and they react. We had the imposition of a broad swath of tariffs, very high tariffs. The bond market reacted, did not react well. The next day, there's an announcement there's going to be a 90-day pause. All of a sudden, the bond market rallies and the stock market rallied very strongly. That's when Richard mentioned earlier it was up about 3,000 points in the day on the Dow. And we've never seen that. So the administration does have a governor, a behavior governor, and that's the bond market. And that's why I say watch the 10-year Treasury, because if they're getting any indication that investors are balking in the biggest, most liquid market of the world, i.e. the U.S. Treasury market, where we've got $8 trillion of debt to roll over this year and another $2 trillion in debt to sell this year, if we do not have successful Treasury auctions as they come up periodically through the year, then we're going to have some real trouble in the market. And I think the administration is keenly watching that. They're not going to let that happen, because then the wheels start coming off the wagon. So I think we've got that as an effective governor for behavior.
It looks like there are no more questions, Chrissy.
There was one more that
there is
just
one
came
more.
through. Yep. Another one on China. What do we know about China stopping rare earth metal exports? Small market impact, or just another bargaining chip to see who gives first?
I hope it's bargaining chip. We really do need those critical minerals. And what do you think, Peter?
Well, I too think it's a bargaining chip. Once it all gets settled out, the flow of those minerals will come again. That's why the administration has been so vocal. Some would say awkwardly and unpleasantly vocal about taking over Greenland, or doing this deal in Ukraine. In both instances, there are deposits of these rare earths. And so we're trying to get our hands on those deposits of rare earths. But there are places like the Democratic Republic of the Congo, which I would not suggest is democratic or a republic, but let's just call it the Congo. They have some substantial reserves of these minerals. Greenland has got them. The Ukraine has got them. There are other places where we've got them. There's a company out in Arizona. It's got the only mine. It's called MP Minerals, and it's not a big operation, but they do mine these rare earths, and it's our stake in the game, if you will. But it's another lever the Chinese could pull, so they pulled it. And so we're going to go back and forth on all this stuff.
So making a sort of a summary comment, seeing no additional questions, it takes me back to the title of this piece, which is Navigating an Uncertain Market, and not for the faint-hearted. Navigation is, I think, a good word for this, because while you can manage risk, you really have to navigate through a market of this level of uncertainty. At the same time that economist that I mentioned at the beginning was addressing his treatise on risk, he said the best way to assess what to do or how to navigate through uncertainty is to have scenario planning. And I think what's incumbent on investors as well as business leaders is to assess what scenarios are likely to develop from this tariff environment and different environment that we're living in. And I know we got a foreshadowing of this today. I think it was United Airlines that put out 2 sets of outlooks, one if this happens and one if that happens. Sounds like Harry Truman's take on economists, that he wanted a one-handed economist, not a two-handed economist. But I think we're going to see more of this where, you know, the prognostications are, if this happens, then this is likely to result, et cetera, et cetera. Any last comments before we wrap up a call that's lasted now almost an hour and 20 minutes?
I guess my last comment would be, it has historically been the case, and we continue to believe it to be the case, that long-term investors are best rewarded if they remain in the markets and do not try to time markets. You try to time a market, you have to make 2 important decisions. One, when to get out, and the next important decision is when to get back in. And that's typically much more difficult, because when it's best to get back in, that's when there's real blood in the streets. And, you know, you look at the situation, the environment, you say, well, I'm not going to wade into that mess. So it's just better to stay in. Stay with companies that are very well managed. And we think we have picked, in companies in which we put client monies, we think we have picked first-rate management teams. These are teams that are highly paid, and they're already thinking about, you know, how to defend their particular charge, their companies, and how to take advantage of all the disruption. Because it's during these times of economic disruption, that's when the really great companies grow. That's when they swoop in and take over somebody else that they never had the opportunity to do. So our counsel would be to stay in the markets. Obviously, you know, you can modify the complexion of your portfolio to allow you to sleep well at night. We're not advocating that anybody stay up at night and worry because they think they've got too much in equities or something, you know, the portfolio is too volatile. The portfolio can always be reshaped to allow you to sleep well at night. That's the beauty of trading in public markets. You can sell at the ready, very easy. These are all very liquid, and then you can, you know, buy something else, and they can be reshaped to lower risk, or when you get to feel more bullish, you know, to increase risk. But it's important to stay in, to stay invested, go for the long term, and just believe that the market, the house bet is that markets go up, and over the long term, stocks have always outperformed every other asset class. And you've got great management teams or great mutual fund investors that are guiding the fortunes of the mutual fund and guiding the fortunes of these particular companies in which we've invested. So with that, Richard, we thank you very much for your time, your interest, and we'll talk to you in the near future.
Thank you all for coming.
Thank you.